Imagine a currency fighting its way back from the ropes. Because that's exactly what the British pound did today. Rising in a wave of optimism after the fresh UK employment figures showed that the job market is holding better than expected. The numbers are in, and they're painting a surprisingly bright picture. So in this video today, we'll break down the latest UK jobs report as promised, why it's pushing the British pound higher, and what the data means for the Bank of England's next interest rate move, and so many other things. So without further ado, let's get right into today's video. The pound sterling gained ground in Tuesday's trading session, supported by stronger than expected UK employment data. Investors who had long been bracing for weaker results were instead met with figures suggesting resilience in the labor market. This sudden change in tone has fueled buying interest in the pound and slightly shifted expectations for the Bank of England's next move. According to the Office for National Statistics, the UK economy added 239,000 new jobs in the 3 months ending June, an impressive jump from the 134,000 added in the previous period. This marked one of the largest employment gains in recent months and indicated that businesses are still hiring despite broader economic uncertainties. July did bring a small decline in payroll jobs, down by just 8,000, but that was the smallest drop since January. The unemployment rate remained steady at 4.7%, matching forecasts and signaling that the job market remains relatively stable. Pay growth was another key takeaway. Average weekly earnings, including bonuses, rose by 5%, and in private jobs, it rose by 4.8%. This wage growth keeps the household spending power intact, but it also puts the Bank of England in a tough spot, as it could keep the inflation pressures alive for a longer time. When a country's job market looks strong, it often boosts investors' confidence in that economy's currency. The reasoning is quite simple. More jobs means more income, more spending, and ultimately a healthier economy. For the pound, these employment numbers came at just the right time. The currency climbed above 1.34 against the US dollar and hit around 86.24 pence per euro, the strongest level since late July. Traders have interpreted this data as a sign that UK's economy may not need aggressive interest rate cuts just yet, which ultimately boosts the UK pound's value. The upbeat UK employment figures didn't just boost the pound. They created ripples across global financial markets. European stock indexes inched higher as investors saw the data as a sign of stability in one of the region's key economies. A healthier UK job market can mean stronger consumer demand and more robust trade, which benefits European partners. The euro slipped slightly against the pound, reflecting the shift in investor preference towards sterling after the report. Last week, the Bank of England narrowly voted to cut interest rates. However, the decision wasn't unanimous, and today's jobs report might make further rate cuts less likely in the short term. Strong employment and wage data suggest that these inflationary pressures could persist, making the Bank of England more cautious. Markets are now pricing in roughly a 50% chance of another Bank of England rate cut this year. For the pound, fewer rate cut means higher interest rates for a longer period of time, which definitely will help the currency stay strong. UK GDP data release. The next big event for the pound is upcoming UK GDP report. If the economy shows stronger than expected growth, it would reinforce the idea that the UK is holding up well despite global headwinds. This could give the pound another boost as investors would see less need for aggressive Bank of England rate cuts. On the flip side, a weak GDP reading could dampen confidence and reverse some of today's gains. US inflation numbers. US inflation data is also on the horizon, and it could have a major impact on the GBP against USD exchange rate. If US inflation comes in lower than expected, markets might price in more aggressive rate cuts by the Federal Reserve. That would weaken the US dollar and further strengthen the pound. But if US inflation stays high, the dollar could rise and put pressure back on sterling. Bank of England policy outlook. Today's jobs report already shifted market bets on Bank of England rate cuts, but policymakers will continue weighing new economic data before making decisions. Strong employment and wage growth suggest inflationary risks remain, which would delay further cuts. However, if future reports show clear signs of cooling, the Bank of England might move ahead with easing later this year. Traders will be watching every speech and meeting closely for hints of the central bank's next step. The UK's latest employment report has given the pound a much-needed boost, giving a signal that the labour market is still delivering solid results despite of global or domestic challenges. So this is all from my side for today. I hope you found this video helpful, and if you do, make sure to give it a big thumbs up and subscribe to my channel for more financial insights. And I'll see you again very soon with another hot financial topic. So until next time, stay tuned.